Hey traders, Jeff Yates coming to you here on Friday where markets are closed today. Thought I'd kind of put just a brief video out this week talking about really what happened this week. This was a very difficult week to kind of get traction in that there was a lot of news reports coming out with Powell, his lackluster viewpoint on maybe where the future is in the economy. There's been a big uproar on that, both politically and also just kind of where we are comparing his comments and his rate cuts to what's happened over in the UK and things abroad. But it's been an interesting week nonetheless. I want to kind of point out a few different things to you in relation to where the market started and how we actually did on some of our trades. It's a difficult trade to be right unless you were scalpy because the market was, as you'll see in a minute, began to move higher, at least on Wednesday, and then quickly was suppressed with Powell comments and putting in one of the largest days. I mean, not the largest as the tariff cut day back last week, last Wednesday, but it was a $17 move, not counting the gap, just top to bottom in the SPY, and a little bit worse in the Qs on Wednesday. So, been an interesting week. We came back strong on Thursday and had a nice credit spread iron condor, and I'll show you why we chose an iron condor and just kind of how to read the market in respect of what's happened previously and kind of where we are, what the candlesticks typically look like, and what they actually mean to kind of get a bead. Now, at Full Throttle Traders, we don't go back and look so much at data specifically. That's important, yes, but we also look where money has been. And a lot of the newer traders that you see out there, brand new, 18 in a Robinhood account, are so much into just strictly data and not charts. And I don't think that's proper. I think you can look at that, but it's also equally important or even more important to look at the footprints of money. And so today we're going to take a look at that. So bear with me and we'll get on the other screen here. Okay, so let's take a look at the SPY up here on the daily chart just to get a kind of a bigger picture. Now, this is Wednesday's bar. You can see that top to bottom bar in the SPY was about 17, almost $18 in range. Then, of course, you have the gap down from here as well. But it doesn't look as bad because the scale of the chart has certainly been reduced because you have these super wide range days that come on board. This was a 23-point day, maybe 24-point day. So this is the worst. This was actually they're all pretty big in here when you look at that. 1, 2, 3. That week was just horrific in the way that the range was in the spreads, the way that these actually moved. This is news generated market like we've never seen. So on Monday, the market did gap up here, and you can see where it gapped up above and looks like it had a chance. And I mentioned on the previous Friday, I did a class, a Zoom call. So look, this is where prices could go because there's going to be a tremendous amount of supply of sellers sitting right there once market gets back to the area. Now, we came to at around 544. This started around 548 and a half. Didn't quite make that area. It was also happening at the midpoint of the Bollinger Band. And I say this often, but the midpoint of the Bollinger Band, simply by default, using default settings, is just the 20-period SMA. And you always want to look at where you are because you have to think about that Bollinger Band. A lot of traders trade Bollinger Bands in different ways, the pinch, the open up, the express, or they look at maybe which side of the 20-period moving average. Now, equally important is the 50, but the 20 is going to be more in line to where you are every couple of days. The 50 is going to be a bit further out a lot of times. So the 20 is the first line of defense when it comes to which side of the 20-period moving average you on. Notice we had this wide range bar that ignited. We never came even, other than one day here, a little bit of a close about break even at the flat 200, the red line here, close above it. But other than that, we spent probably 98% of the time below the 20-period moving average. Below the 20-period moving average. Doesn't mean you would have made money if you shorted, because it's all based on where you did and what your risk reward is, what your stops are, and things like that. But this week, you see, we had to start a nice startup in the week here We gapped up to this area here, and we thought we are going to go have a quick little head fake higher, thought we were heading back to here, came all the way down. Then you can see by the definition of the tail, we moved up about 55, 60%, maybe about 55% back up to close the day out. So it got a little bit positive towards the day in here. This day was a narrow day. If you look at the range on this day, we had about an $11 range. That's pretty dramatic, not comparatively speaking to these, but normally that is. But we had an inside day. And that's normally what you have. When you have wide range days, you have inside days, or at least smaller consolidation, and it doesn't typically go that far outside of the box, top to bottom. This is what happened here. This is where we spent 2 days above the 8 trying to find footing to get back to the trend line. If you remember back in here, I drew this trend line and I said price does not like to be too far away from A, moving averages, specifically the 20 or the 50, and B, it doesn't like to be that far away from the trend line. And again, this is all news driven. I certainly didn't expect this bar to come back, but I did expect some bit of a grind. If you take this bar out, some bit of a grind back to at least close the gully or the gap between that trend line and where price was. Again, the market doesn't like that. It's almost like it doesn't like a gap. It likes to complete the market and fill the gap. It's the same way. It likes to fill that bridge of a definition where it was so steep that the trend line begins to kind of show here, the trajectory here, but it doesn't actually get back. It needs to kind of do something, not all the way, but at least some. And it did that on that tariff day. And then 2 days we spent Monday, Tuesday above the 8. We opened up below the 8. We did a retest here at the bottom of this bar and came back down, ended up with what we call a more narrow range body. Actually, Thursday was more so. No wide range bar, inside day. And I'll show you why we chose an iron condor on this day using the SPX. So 2 days above the 8 EMA, the dotted white line here, and 2 days below the 8 EMA. Again, not quite the narrow range body you had on Thursday, but when you have wide legs and it closes in the center, you could call that by definition a narrow range body. It's not a narrow range bar. That is a narrow range bar where it has filled to both sides and it closes, narrow range bar. This is narrow range body. What's the difference? Just longer legs on both sides, but the effect is the same. That means it's indecision, it's doji-like, and there is compression, which means that typically it's almost wedging inside of the channels. So you usually have a move higher or lower. You start to get a little bit of an acceleration move coming out of a narrow range body. And the same with a narrow range bar. This would be even more so. Now let's go down and drill down to the 2-minute chart. And despite, take a look at the 2 plays that we did here on the credit spreads. We did this here, and I've talked about this in the room. I said, look, this is a directional play because we came down, we double bottomed off here, or some people might call that a W bottom, but we waited for it to take out the pivot and get back and hold the VWAP. And then right when the crossed here on the 2 EMA on VWAP, this is when we went long. Which means we had a bull put credit spread. We were basically biased to go for the market to go higher. And the market did, and it went with a vengeance. As a matter of fact, it went down from in a 8-minute time period from 531 and change up to 535 and change, about a $4 move in 8 minutes. And of course, at that point, we knew we were on the right side of the trade until this happened. And again, in hindsight, this is kind of a little bit more investors were sitting on the sidelines waiting on the Powell speech. They didn't expect it to be this bad. And then, he came out with tremendous hawkish warnings for whatever reason. And we went from a market around 531.50 to 520.50. So about $11 move from here. Already a decent move from the gap, another move down here. So this was definitely a stop out. But on Friday, because we had such a wide range day, here's the 30-minute low, here's the 30-minute high, or close to it right in here. And we barely took this out higher and came in lower. But notice in this area, you had whipping bars. They were definitely more back and forth. See the whippiness in here? We really don't know which way the market's going. And these aren't shallow bars. This is 526. This is 528. That's a $2.5 bars. They're whipping back and forth. So the market takes off here, takes out the high of the morning, and does the same loop back and forth, and then progresses and takes out the low and gap fill and the open line back to here, and then work its way back up. But this told me here, and the fact that we were about midpoint, that we will probably have an inside day. So right in this point, about 10:30, we threw right around here, we threw an iron condor out there. And it really wasn't challenged that month. We did $1.05 credit on a 10 wide. And again, we're going a lot tighter in the spreads because they can live longer when you start to have these wild days. Nothing's going to take you out of a 20-point day or a 17-point day. Nothing. But you could have been wrong on both sides, on the bear call and the bull put on Wednesday. But Thursday, this held pretty well. We're able to get full profit, let the back half expire worthless on those trades. So again, this was just more of a product. If you look at this back on the blue chart, of an inside day is typically what happens after a wide range day. A lot of confusion in there. And then you want to find your mix of how you can play in this. Now, again, we're on the downside. The 8-period moving average earnings season is back upon us now. And so you have Netflix reported on Friday afternoon at around 975. It gapped up to 1,020, closed at 1,006. We'll see how that works on Monday and Tuesday. So we're just kind of getting back to earnings, and that's going to even shuffle the market a little bit more around because of, the way the market's been pulling back ultimately and where the earnings might come in as a result of the market pulling back. Are they going to go higher or lower? We're just kind of chop around still. Q's is much the same. I don't need to go too much into this. Above the 8, below the 8, inside bar. But it definitely leaned a little bit heavier in technology. Let's take a look at this on the tech side of things. You can see the 1-week performance technology was about 0.7 off, whereas the overall over the week and then over the day performance, you can see that we're definitely shadowed by energy. Energy reports came out on Thursday. Everything was good news. XOM, USO, XLE doing well. Consumer defense doing well. And probably in retrospect to the gap down, Cokes, Colgate, Johnson & Johnson do well in that type of environment. Real estate's been doing pretty well here with some of the new reports coming out on new housing starts and pending home sales and so forth. But the thing you want to focus on is technology. Now, healthcare is down here. It finished out positive, but it was a lower part of the positive here. But what really dragged them on Friday was we were down 600-700 points in the Dow at one point when the NASDAQ was basically flat. Why? Because United Healthcare reported and they had horrendous, at least the reaction to the earnings was horrendous. I'm not sure if it was actually bad or not, but it was a terrible day for UNH among the way that stock been trading because of the recent news. And then technology finished off in here. So we finished at a narrow range doji. So indecision bar coming into the holiday today and, of course, Easter weekend as the traders begin to digest the upcoming week. So we'll have to see where we kind of go from here. But in general, we are still in a downtrend, but albeit a choppy downtrend. So just stay cautious. I think it's probably good to stay a little bit scalping until we kind of come out of these areas and get some definition, because one day we're very high, the next day we're low, and then in the same day we're low, we're bouncing back up 50-60%. So we don't really know where we're at in the grand scheme of things. But so I think the market is still kind of out to lunch as far as where we are. Again, just taking a look at the daily chart, you can kind of get the picture of the SPY. And that pretty much tells the story right there. Indecision, inside day, doji. We've got below prices wedging here a bit, and we'll see what Monday, if we get gaps in earnings, they're going to send this market back higher. Market needs to clear this trend line, or probably at least stay in here to continue to develop the wedge, and then maybe it could break back out on decent earnings from a lot of companies. So we'll see how that actually transpires. So again, thanks again, Jeff Yates at Full Throttle Traders. I hope you enjoyed the presentation here. See you in the room on Monday.